the investor you've been and the investor you're becoming. Let's start talking about this with decisions and how decisions reveal patterns. So right now, the market is down a bit. I've got the military action happening in Iran, and inflation's kicking up, and employment's kicking up too. How are you handling this situation? Are you looking at it as an individual kind of isolated situation, or is it something that happens regularly? Well, here's a hint. If you go back to this time last year, actually 1 year ago, and think about the tariffs turmoil, Liberation Day, all of that, how did you handle that? And then if you were to go further back and look at any time the market was down 5-10%, how did you handle those? If you look at those and look at the decisions that were made, you might start noticing a pattern. Or you might not notice any pattern, and that in itself is kind of a pattern. But over time, your decisions reveal patterns, and your patterns reveal who you are as an investor. Let's take a look at three different types. So the drifter, somebody who's frozen or systematic. So the drifter is somebody who goes from strategy to strategy or buys things for certain reasons and sells them at other times for certain reasons. If there's gains, they might get more aggressive. If there's losses, they might get more conservative. There's a lot of drifter investors out there. On the other hand, a frozen investor is someone who may have had a very bad loss. So think about some folks who actually held through or tried holding through the 2007, 8, and early 2009 bear market. They might have gotten, as a result of that, they might have become just frozen and not able to do anything, or shifted all their money over into a money market fund and just can't do anything for a long time. The third kind of investor is systematic, right? They have a set of rules, they have a structure, they know what to do, when to do it, how long to hold things, and so forth. So most investors are not systematic. And if you want proof, you can just go look at Morningstar. Find Morningstar, morningstar.com, and look up their Mind the Gap report. They publish this annually, and what they consistently find is that most investors underperform the investments in their portfolio. So they own these certain investments, and if you track that over time, what they see is that the actual investments are returning more than 1% a year than the actual holdings, the return of the investor. So it's a matter of timing, buying and selling, and not doing that at optimal times. Now, I can speak to this because I have a little personal experience in each one of these. Most of my adult life, I was a drifter as an investor. I had different strategies. I tried different ways. I had certain reasons for buying certain things and selling them later, and there wasn't really much of a systematic approach at all. I've also been frozen at times and just stayed in money market funds or short-term treasuries. And those experiences, I can count the real cost because in terms of returns or years that I've lost on the investment portfolio returns. But what they did do was push me towards a systematic approach. So I am much more of a systematic investor now. And I hope to help other people become that way as well. So let's ask a question. 10 years from now, in 2036, if you were to look back on the previous 10 years, here's a question to think about. Actually, it's probably a couple of questions. But you're probably not thinking about abstract topics like, was I disciplined, or did I follow a process? Was I really disciplined about my process? You're probably asking some different questions. You're probably asking, did I suffer any really big losses I couldn't recover from? Was I invested when I was supposed to be invested? Did I spend those years stressed out or worried, or were they okay? There's a way to help answer all of those questions positively today, and that's to adopt a systematic approach. A systematic approach decreases real-time pressure, but you don't have to make the decisions all in the moment, especially under stress. Your actions are chosen ahead of time. You know what to buy, when to buy it, how long to hold it, how much to buy, when to sell, how much to sell. All of those things are thought of ahead of time so that you're not trying to make it up in the moment, which doesn't turn out so great a lot of times when you're doing that under great stress. In addition to decreasing real-time pressure, it just makes investing much less stressful. And that's the idea, that's the foundation behind the smart signal system. Now, the smart signal system is just one. There are many, many, many different systematic ways you can take to investing, and I would just encourage you to pick one because it has multiple benefits. Okay. Nice talking with you. And I have to add, I am not a licensed financial advisor. None of this was meant as an investment advice. It was purely an educational service. My full disclaimers follow. Okay, take care.